Hey guys, and welcome to today's video. So in today's video, we're going to be discussing how to find draw on liquidity. So for you as a smart money trader to be able to maximize your understanding of price action, there's something actually you need to be focused on, and that thing is no other than identifying what the next draw on liquidity would be. So if you're able to hone your skill sets to be able to identify what the next draw on liquidity will be, you eliminate most of your confusion when it comes to identifying directional bias and what you should be doing at every point in time in the forex financial market or in price action. So moving forward, here is a trade I actually took yesterday on the 1st of November 2023. Today's at the time of recording 2nd of November 2023. So you can see on this particular piece of price action here, we saw a displacement in price into this particular area of liquidity right here. And the moment we saw a reaction in price to the sell side, you can see we had our entry right there in price action. And this is the before of this particular trade. You can see just at the low of it, we have our take profit just below this particular region right here. This is where our stop loss is right here. You can see it's here SL, down here is TP. So this was a trade we took on the first on GBPUSD on the 5 minutes. Now on the next slide, this is the after of the trade. You can see we ran liquidity right there. Our stop was above that region. Our take profit was below this particular region. And you can see the way price ran to that particular area. So price ran liquidity on the buy side right here and took out liquidity on the sell side. So this is what being able to identify draw on liquidity is going to help you achieve in the forex financial market. So how can you go about being able to identify this particular draw on liquidity? And that is going to be using my refer to target approach in the forex financial market. So what I used to be able to achieve that particular result you see on the previous slides was the refer to target approach. And in today's video, I'm going to be explaining in details, step by step, on how you're able to do that using this refer to target approach or mentality, the way I like to call it. So the first thing you want to focus on is you want to focus on your area of reference. Mind it's a refer to target reference and refer to target mentality, which is a reference to target. You are referencing a particular liquidity to target another liquidity. So the first area you want to of your mentality or your idea should be building your area of reference. So for your area of reference, you want to be focused on time, displacement or impulse move, then area of liquidity. So you want to be focused on a particular time zone. It can be the London session or the New York session. And the next thing you want to be looking out with for within that particular session is a displacement in price. And now this displacement in price is not just a random movement, but this displacement in price must be to an area of liquidity. I don't get it now, must be to an area of liquidity. Good. So you want to see price move impulsively to an area of liquidity within that particular time zone. You get that you've already identified. So this is where you're going to be focused on for your area of reference. So why in your area of reference on your reference zone, you want to validate if price is going to see a reversal from that particular area. And the confirmation is that you want to see liquidity rate. So when you see displacement into that particular liquidity area on that particular time key zone, the next thing you want to do to validate that particular reference zone is, or to make that place a valid reference zone, is that you want to see a liquidity rate. In other words, you don't want to see price defile that liquidity and keep pushing higher in a buy trend formation, or you don't want to see price defile it on the sell side and keep pushing lower. You want to see price run that particular liquidity and give you a reaction in price. So that will be the validation of that area to be a reference zone. Though I'm going to give you examples to be able to give you better understanding of what I mean. Moving forward, then the last thing you want to just focus on is your area of target. You want to know, okay, now you've already identified your reference zone. you've already validated the reference zone. The next thing you want to focus on is what is that area of liquidity or inefficiency on the opposite side of the market that you're going to target. And you want to target the near zones. You don't want to target the one that's far. You want to target the close ones, the ones in close proximities. And I'm going to give you also examples in the charts to better drive home that particular idea. So let's see some chart examples. So right here on the chart is the GBPUSD on the 1 hour. So I'm going to bring in the period separator to classify the days, and I'm going to be going over two examples, and we're going to be calling it a day in this particular video. So let's focus on this particular day right here. So let's focus on this particular day. So I'm going to remove the period separator out. So mind you, say you want to focus on a particular Q zone for your area of reference. So if since we're using the GBP I'm going to be focused more on the London session Q zone. So and that's going to be 3 o'clock to 4 o'clock New York time. So zooming this in out in real time based on chart time, that is going to be 9 o'clock to um 9 o'clock and 10 o'clock chart time. So I'm going to be putting the mark this vertical line on the 9 o'clock and on the 11 o'clock. So in between this 9 o'clock to 11 o'clock, which is in between 3 o'clock to 5 o'clock New York time, I want to see my particular reference zone gets validated. How do you get it now? So now we've marked out time, right? The second thing I say you want to look out for is displacement. So okay, I'm going to push this back here to give us clarity. So within this particular I'm bringing that back. So within this particular zone, which is from the 3 o'clock to the 5 o'clock, you want to see a displacement in price. Now, this displacement in price, you want to see it displaced to an area of liquidity. Now, with the current area we are in price, the moment this particular candle close, mind you, are using the benefit of hindsight here. So the moment this particular candle close, you're looking for areas of liquidity. Now, area of liquidity is old highs and old lows for those of you asking. So we have old highs. This is an old high right here, and if I mark up to the buy side, I'm coming. Let me get that correctly. If I mark up to the buy side, that will be another area of liquidity. Now to the sell side, this will be the area of liquidity, and ultimately this other one, or if price want to go lower, will be this other lows right there. So we have all these lows and these highs at the area of liquidity, and we have a fair value gap, also an inefficiency at this zone right here. We have an inefficiency at this zone. So we want to see price tank into any one of these particular area of liquidity and give us a reaction in price that's going to validate that particular area as our reference zone. So mind you, I said for you to identify a reference zone, you want to be focused on a particular time, which is a Q zone. So we're focused on the London Q zone, which is from 3 a.m. to 5 a.m. New York time. Now, the second thing you want to wait for is a displacement in price to an area of liquidity. So that means we would have already identified our area of liquidity, and which is what we have done right here. All this series of lows and series of highs. So whichever one price displaced to is going to be the one we want to actually focus on for validation. Now, on the validation time or zone, we're looking for a liquidity rate and a reaction in price. Now, when I talk about reaction in price, I'm talking about market structure shift. You understand? And I'm going to show you what I mean, like I said earlier. So we can see that the moment we step into this particular time zone, which is 3 o'clock New York time. So let me just still move this for clarity. So we saw a displacement in price to the sell side. So the moment this particular candle closed on the 1 hour, we can see that it ran these lows and it also ran this low right here. So this particular area now becomes significant. You understand? So we want to see if price is going to keep pushing lower to attack this particular low. And what is that? How we're going to know that is we're going to drop down to the much more lower time frame. So when using this particular approach and you're starting from the 1 hour, the next time frame you want to drop down to should be the 5 minutes, not the 15 minutes. For you to get optimum entry, you want to drop down to the 15 minutes. And if you drop down to the 15 minutes right here, let's do that. So dropping down to the 15 minutes, you can see we had an impulse If you look at there, this was where the 9 o'clock candle actually closed on this particular weak rejection to the buy side. So the moment, okay, let me zoom that out for those of you that want to see what I'm talking about clearly right here. So we saw price drop here. This is 9 o'clock. You can see that 9:55. So this was when the 9 o'clock candle closed, which was 3 a.m. New York time, and this was 10 o'clock chart time, which became 4 o'clock New York time. So you can see price drop down here and give us a reaction in price. So now when we talk about reaction in price, I'm simply talking about the W pattern right here, because we are looking out for reaction in price to the buy side. We want to see how we catch buy trades. So we look at the W pattern. So this is a reaction in price, more like a market structure shift. So you see one, two, up, down, up, breaking structure right here. So here becomes your area of entry. So this is where you enter right here. So you enter here, put your stops here. We should give that's at 100 pips. Sorry, 100 pipettes, which is also going to be 10 pips. So you're going to be targeting this particular high. Mind I say you want to target the near hanging fruit. So this liquidity area to the buy side is going to be your area of target. So you can see how you use just the refer to target approach to be able to identify draw on liquidity. So we wait for a Q zone, identify the area of liquidity, wait for a displacement to that area of liquidity, validate that area of reference by looking at liquidity rate and market structure shifts, which is I call a reaction in price, and we see that reaction in price to the buy side. That becomes your entry. You enter there, put your stops below this low, and you target this particular high right there. As simple as that. So that is one example. Let's look at another example. I'm going to be using the exact trade I took yesterday to be able to give us the last example for the refer to target approach to be able to identify draw on liquidity. So going back to the 1 hour, I'm going to be going back to the 1 hour. So going back to the 1 hour, let's mark up 3 a.m. to 3 a.m. to 4 a.m. New York time, which is going to be our London session Q zone. So that will be 9 and 10 o'clock chart time. That'll be 9 and 10 o'clock chart time, but I'm going to put it at 11 so that we can see these candles properly. So we have an area of liquidity right here. We have an area of liquidity right here. That's an area of liquidity. And if price is to push higher, we're going to be running into that particular fair value gap right there. So if price to push higher, I want to see price react from that fair value gap right there. So we don't want to see price defile this high and defile this fair value gap and keep going higher. We want to see price react in that particular area. Good. So we've identified our area of reference because now we have time, we have liquidity in terms of old highs and fair value gap in our favor. Now, all we're waiting for is displacement in price. So let's say you were watching price in real time. So let's drop down to the 5 minutes and see how things played out. So this is another external extra high on the 5 minutes. You can see clearly right here, which was the one I showed in the screenshots that I took. So we saw from here price ran this low on the sell side and displaced all the way into that area of liquidity within this particular Q zone, tanking into that particular fair value gap all the way from the 1 hour. And we saw a reaction in price. Price went up, came down, went up again, and came down, giving us a reaction in price, a market structure shift as an M pattern right there. So the moment this particular candle closes on the sell side, here becomes your entry. You put your stops above this particular high. Where do you target? You target the nearest area of liquidity to the sell side, and which is this particular low right here. So if you enter this particular zone, putting your stops above here at 150 pips, which is going to be 15 pips, you're going to be targeting this particular lows right here, which is also going to be 226 pips, which is going to be giving you 26 pips to the sell side. And if you had held longer, price would have dropped lower, but you don't want to do that. You want to target the nearest hanging area right there. So this is how you actually go about implementing the refer to target approach to be able to identify and take advantage of draw on liquidity. So I advise that you take this particular approach and apply it on various price action, test them and see how it works for you. You can actually apply it also on the New York session. I actually showed this only here in this video on the London session, but it actually works in all sessions. You understand? You only apply it in every single session, but still applying it methodically just the same way I outlined it in this video. So if you don't understand this video the way I explained, maybe I went over something too fast, I recommend you watch the video as twice or three times to better understand the way I explained it. And if you are still lacking in understanding, you can leave your question or your thoughts in the comment section. I'll be sure to get back to you. If you find value in today's video, you hit the like button. If you're new to this channel, hit the subscribe button. And we are almost getting to 1K here on this channel. So I recommend you hit that subscribe button and join us and increase this journey all the way to 1,000 subscribers here on this particular channel. So I believe you found value in today's video. Thank you very much for watching and see you in future videos.